loan is less than $10,000, then no tax update. Capital gains only come into play if it is a capital asset. One Bitcoin is worth $39,984.70 in US dollars. Ask Roger. Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. Hey guys, I'm Roger Herring. I am the Investor's Accountant, and hey, welcome to my office. You know, I've been getting a lot of questions lately about my short videos and things that I have said in there and things that I didn't say. So you know what I decided to do? I thought I would take a longer segment today and just answer some of those questions. So we're going to call today Real Estate Tax 101. Now, the first thing that you have to do is you've got to have your LLC. Your LLC is the basis of all your other structures, everything you do. It's how you get your legal protection, and it's how you it's how you decide how you're going to be taxed. That's right. You can make an election to be taxed as anything you want when you're an LLC. So most people start out flipping properties. And when they flip properties, that's ordinary income. So let's understand the type of income. If we are flipping, if we are wholesaling, if we are a realtor, if we are building houses, if you are an agent, if you are a property manager, all of those are real estate pro professions, but they're all ordinary income. If you are ordinary income, you have to protect yourself from this thing called self-employment tax, which is how Uncle Sam gets the tax from a corporation, from the self-employed. From the self-employed. So we can elect to be taxed as an LLC, taxed as an S corporation when we are flipping and wholesaling. Now, what's that election going to do? That's going to mean that we become our own employee. And yes, we have to pay ourselves a W-2 salary. But here's the trade-off. And I'm just going to use round numbers. Don't go out and use these numbers. This is just for an educational example. Let's say that you make $100,000, okay? You're just an LLC and you have no tax election. Here's what's going to happen to you. You're going to pay income taxes on the $100,000, and you're going to pay $15,300 worth of self-employment tax. That's the Social Security and Medicare. Yeah. Now, let's assume that I am now instead an LLC taxed as an S corporation. And let's assume that I pay myself a $50,000 W-2 salary. I'm still paying income taxes on the full $100,000 because I now have a $50,000 W-2 and I've got a K-1 which passes through to me for another $50,000. Income taxes don't change. Here's what changes. I am only paying self-employment tax on the $50,000. So that $15,300 over here, I just cut it in half over there. Yeah, now it's 7 and some change, and you get that every single year. That's right. Now, how do we reduce the taxes? Well, we develop a tax strategy, and there are a whole lot of things that we can do, and even more things that we can do if you're qualified as a real estate pro. But that means you got to have some rental properties. So a lot of people start flipping and wholesaling with the intention of moving it into buy and hold. So let's talk buy and hold for a minute. You do not want to have your flips and your rental properties in the same LLC. One, that is a huge asset protection issue. But even more importantly, from my world, they are taxed completely differently. You've got passive income coming off the rentals. You got ordinary income coming off the flips and wholesales. And the tax rules, if you hold a rental property inside of your S corporation, are nasty. They're not pretty at all. We're not even going to go there today. That's a whole other 12 to 15 minute conversation. All right. So we're going to keep our rentals totally separate in a separate LLC. How's it going to be taxed? Either as a partnership, which flows through to me and flows through to a business partner, or I'm just going to have these as that LLC is going to be what we call a disregarded entity. The IRS doesn't care about it. They don't even acknowledge that it exists. Okay? So, when that's all said and done, we've got our LLC. What are we after? What do we want to pass through? We want this thing called a phantom loss. Phantom loss means it is simply a loss on paper. It is not real. It is created from going in and recovering the basis of the property through depreciation. And hey, guess what? There are some tactics that we can utilize that will allow us to accelerate that depreciation. That's pretty cool. Now, how much of that created phantom loss that you can deduct against all of your other income totally depends on what type of investor you are. The IRS says there are three. That's right, there are three types of investor. But Roger, I thought I was an investor when I'm flipping. When you flip in wholesale, the IRS considers you to be in the business of real estate. I call that being a BORE, B-O-R-E, business of real estate. An investor holds for long-term appreciation and may collect rents. Therefore, only if you have the rental properties are you considered an investor. Okay, here we go now, guys. We want to know which of the three statuses we are. The first one is I'm a passive investor. The passive investor writes a check. The passive investor gets a check. He doesn't do anything on his properties. He is passive. He sits back and does nothing. So all he can do is take that phantom loss and apply it against other passive income, because its passive loss can go against passive income. Well, where does that come from? It comes from limited partnerships, or it comes from rental properties. What if I don't have any? Well, there might be a way to create some if you are married, and we can turn part of your operation into an entity that literally throws off passive income instead of ordinary income. There are ways to do that, but that's a whole different discussion. So, passive is the first guy. Well, what happens to the losses if I can't take them? They're going to carry forward indefinitely until a time that you can. Well, when would that be, Roger? Well, when you sell the house, that's the most common. Or if all of a sudden you start making rental income as opposed to rental losses. That's how it works. Now, the next type is the active participant. The active participant is a guy that gets out and swings a hammer. He makes the decisions on his property, he works on it, he manages it. Now, you can still have a property manager as long as you're not rubber stamping their decisions. I have a lot of clients that will qualify as an active participant because they make all the calls and arrange all the maintenance. You know what that property manager is there for? To answer the phone at 2 a.m. and to collect rents. That's it. That's it. Now, because he is active on his properties, the IRS is going to allow him to take $25,000 of passive loss. Now, once again, that is a phantom loss that we have created with depreciation and apply that against all of his other income. That's pretty cool, but there's some limitations. First limit, no more than $25,000. Anything above $25,000 is going to carry forward indefinitely and be treated just like the passive guy. But also, once your income hits $100,000 a year, you go into phase out. When you go into phase out, you move for every dollar over $100,000 that you make, you're going to lose 50 cents of your deduction. So as you move from $100,000 to $150,000, you lose everything at $150,000. It phases out over time, over income. Now, once you were totally phased out, that means you get no write-off against your ordinary income this year, and you're treated just like the passive guy. Everything flows forward. But there is a better way. And this is one of two goals that I encourage all of my real estate pros to grab onto. All of my real estate people should become a real estate professional. What does that mean? Does it mean having a license? Nope. It doesn't have a thing to do with having a license. So here's what we do. It's all about time. There are 3 tests. 1, 2, 3. Test number 1. I spend more than half of my for-profit or working time in a real estate professional profession. I already called them out. And I am an owner. So you have to be an owner of a brokerage, or owner being a real estate agent or a flipper or a wholesaler or a property manager or a residential home builder, and sometimes a commercial builder might qualify. Okay, that's number 1. Number 2 is easy. You got to have 750 hours as an owner across any or all of those professions. And oh yeah, being a landlord counts too. Now, here's the final piece of the puzzle. We make an election to treat all of your rental activities as a business, single business. And over all of those rentals, between you and your spouse, you have to have 500 hours. Now, the 500 can be part of the 750. The 750 and the more than one half of for-profit time, one spouse must qualify individually. But for the time to prove material participation, you can combine. Okay? Now, there's also 6 other ways to prove material participation. The 500 hours is just the most common. Okay? Now, what do you get if you check all 3 boxes? You get no limits. This is the goose that laid the golden egg. That $25,000 worth of loss that you can write off, that just became unlimited. It went to infinity. And there's no $100,000 cap. Guys, I've got clients that are real estate pros that legally have not paid tax in over 10 years. Some of them almost 20 years. Here's how it works. Let me give you an example. I've got a husband and wife team. She's making about $300,000 a year, working downtown. She's an executive. He manages their rental properties. Now, those rental properties throw off positive cash flow every single year, anywhere from $100,000 to $220,000, depending on the year. How do they produce the cash flow? Well, there's the natural cash flow coming off operating the property. There's cash out refis. There's all kinds of potential. You know how much of that is taxed? Not 1 red cent. You don't tax cash flow. We tax profit. Now, on paper, do they have profit? Nope, they do not. In fact, they average anywhere from a $20,000 to $110,000 loss, depending on the year. And this is all created with what? Depreciation. Isn't that cool? And because the husband qualifies as a real estate pro, we can take that entire loss and apply it against the wife's income. Yeah. So they're getting a big honking tax refund. They've put a couple $100,000 into their pocket totally tax-free. Guys, this is what I call making money without making money. And it is awesome. Now, here's the deal though. Let me explain something to you. The underwriter that goes over your loans does not have the same goal that I do, to reduce your taxes. In fact, the underwriter would like to see income and like to see you paying taxes. Okay? If you're going to be borrowing money, we got to find that happy medium between your ordinary income activities and your rental activities. Okay? Now, depreciation is cool. Anything we do with depreciation, they're going to add right back, but the underwriter might limit us on some other opportunities. Okay? Now, I've said a lot about depreciation. Depreciation is the king of all deductions because it can be manipulated. And through strategies such as cost segregation, we can take depreciation that we would have to spread over 27 years. We can take it right now. And that's what the next video is going to be all about, using depreciation tactics. You know what? If you got a question, put it down there in the comments, or you can shoot it to info@investorsaccounting.com or message us on Facebook. It's great to be with you. Till the next time, Roger out.